Welcome to the Capital Discussions Roundtable. I'm Tom Nunnermaker with our guest Steve Papale from Discover Options and Option View. Before we get started, just a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that out of the way, Steve, welcome. First time on the round table. I'll pass the ball to you so you can share your screen again. But it's nice to have you here. Maybe you can tell the people listening a little bit about yourself before you get started.
Yeah, thanks, Tom. Great to be here for the first time. Again, my name is Steve Papale, and I've been in this options world now for almost about 30 years. I started back in 1986. I was a market maker at the Chicago Board of Options Exchange, mostly SPX, OEX, a little bit equities, but I ran a trading firm down there for years and years, and sort of migrated off floor in the early 2000s and traded a little bit upstairs, and been involved with it sort of ever since. Got involved in the education really, and in about 2007 I joined Discover Options, which is where I'm at right now, and just enjoy the heck out of it. I've seen the whole change of the trading world since, back when I started, we didn't have the technology that we have now. Everything was pit traded. There was, all through brokers. Now it's just a whole different world. It's people say it's not even trade. It's more technology now than it is trading. But you still need to know trading. You still need to understand options is not a simple game. It's more, they say it's sort of compared chess to checkers, I guess is what they used to say. Stock trading to option trading. But anyway, that's sort of my background. And I'm happy to be here. Now I understand the mix of folks here is sort of intermediate to more advanced guys. So it's always a challenge for me as a presenter to these things to try to present stuff that everybody, to find that common denominator. What I've done today is I sort of created a presentation I did a while back that really was born out of conversations that I've had with students over the years, mostly at Discover Options in our mentoring program. We kind of get these same sort of general questions that come up over and over again. And since this is my first time, I thought I'd come in and present this rather than a specific trading strategy. If I come back, and I can always put out different trading strategies that I use or some of our guys use. But for today, I have some concepts that hopefully everybody can take something out of this and use it in your own trading. Some of you may know some of this. Some of you this may be a little newer. It's hard to say, but the idea being is that I want to present sort of a toolbox of information that no matter what kind of strategy folks are trading, that they can hopefully pull something out of this today and use it yourself. So that's the idea. So I'm going to go ahead and get started. We're going to take a look at this. And I really, this is such a disturbing picture. I always like to try to find a slide of something that kind of introduces the program and obviously take a look at option concepts. And I thought, okay, let's find an eye. And this is what I came up with. It's I'm not sure if this is real or not. I thought maybe this is a real tattoo on somebody's arm, or if this is like, I don't know, photoshopped or whatever. But it's one of those things that you just, it's like looking at the sun. I just can't look away, even though it's just strange looking. So anyway, all right. What we're going to do is we're going to cover all these different topics. I'm going to kind of run this in like a bullet form. And if anybody has a question about anything, just feel free to just put out a chat. Tom will pass it along to me and interrupt me, and that's fine. we're going to talk just briefly statistics and trading, and obviously you'll get what I'm talking about here: standard deviation, implied volatility, expected return, as opposed to potential return, delta and probability, something called dollar delta, which our guys use sometimes, and then some of the exercise and assignment ways. It's very easy to predict early exercise for those of you trading American options, especially in the equity world. We've just had questions about that, so I thought I'd put that in here also. And then the practical aspects of Greeks. We spent a lot of time in our mentoring program on Greeks. I teach it, and we spend time on the four main Greeks. We don't deal much with row and the other ones, but and people always say, well, how do you use this? You know, this is all great. It's very theoretical. It's all interesting, but tell me how we can use this day in and day out. So I try to address that a little bit. So those are the topics. So the first thing is we have this statistics and trading, and I don't care what you're doing, how you're slicing and dicing it. At the end of the day, all trading is based on statistics and probability. That's the bottom line. Whether you're a directional trader using some technical analysis, some support and resistance, and I don't trade that way personally. I'm more of a non-directional guy, and I think part of that, or most of that, comes from my floor trading background. We never, at least I didn't, in the indexes, most people did not pick direction. We were hedgers, and we were buying edge, basically. So I'm non-directional. So whether you're a technical guy trading directions or directional, or whether you're a non-directional, which effectively means you're trading a magnitude, an expected magnitude of movement, it's based on those statistics and those probability. At the end of the day, no matter what you're doing, you have to sort of plant what I call our trading flag, based on the probability and expectation. So you have to decide, okay, if I'm a technician and I'm going, I expect the markets to rally, I got to be long deltas. I got to set up for that. Or if I'm a non-directional guy, I have to play for the market to stay, some range of movement, expected range of movement. That's what I mean by our trading flag. And obviously that's based on the potential realization of edge. And we're all in there trading edge. However you define edge, we don't trade unless we feel that it's worth it, it's economically profitable for us to capture edge. It's sometimes easier to identify the edge than it is it's always easier to identify the edge than it is to capture the edge, but sometimes you have certain reasons why you just can't capture the edge, like technology, high frequency trading, high infrastructure costs, et cetera. And the profit in the trade is really based on the market reality and risk management. So we can set up our trade and we can do all the things that we need to do, set up risk management, P&L targets, et cetera. And at the end of the day, what we realize is really what the market does and then how we manage that risk. So in the old days, we didn't have this really easy way of calculating standard deviation, believe it or not. And I'm just kind of going over this because this is kind of a baseline statistic for trading. And nowadays, the software does all of this, but I put the formula in here for those of you that it's not a difficult formula. But what standard deviation does is essentially is used to measure expected variance or volatility in an underlying over a specific time. So I have this formula here. It's pretty straightforward. It's just the standard deviation is equal to the underlying times the implied volatility multiplied by time remaining to expiration, which is the square root of days divided by 360. And that annualizes the time. So I just pulled an example out. So in this case, I think I put up the SPX is what I did, but you've got the underlying would be 2,067 times a standard deviation or a implied volatility of 11%, And then I just figured 20 days. So and I couldn't get the square root to come up right. So that's square root of 20 over 360. If you do that math on the calculator, you come up with plus or minus 54. So what this tells me is that one standard deviation, or 68%, there's a 68% expectation. The SPX is between 2013 and 2121 over the next 20 days. And that's all that really means, is we're dealing with the one standard deviation, is that 68% expectation. And again, I work with OptionView. Our software calculates this very easily. You can see this in a nice way on all the whole matrix and all that. So you don't have to use it in longhand anymore, obviously. When you're dealing with any of these statistics, you deal with this bell curve. And when we talk about the distribution of probability, we talk about one standard deviation being the 68% probability. The 2 is the 95% probability, and the 3 being the 99% probability. So, anything beyond 3, you start to get in what they call these black swan events, 4, 5, 6, I don't know, 10. I guess you could just keep going. These things that have just a minuscule probability of occurrence, but, obviously there's still statistical positive expectation of those kinds of things. But we typically only look at up to 3 standard deviations. And then all I did here is I just created this graph, and I wanted to just show how the bell curve moves with different changes here in volatility, implied volatility. And you can see the measurement here on the color codes of what the different standard deviations are. So you can see the red is the 1 standard deviation, and then inside the green is the 2, and then inside the blue is the 3. So we can see under a 30% implied volatility plugged into that formula, this is what a distribution, a normal distribution bell curve would look like. Okay, it's got the kind of the hump there in the middle. Now, if we increase the input of implied volatility and increase it up to 40%, you can see that what happens is the curve sort of expands outward, as we would expect. There's really nothing, particularly earth-shattering here. As we increase our our input of implied volatility, the standard deviation is going to get bigger. Now, it flattens out too. You can see that as it goes down, we get more of a pointy curve, and as it goes up, it just sort of flattens out. Back in the crash in '87, right when I was brand new and had no idea what I was doing, and still trading, probably not, didn't know enough to be scared at that point. We had a situation where implied volatility went crazy, like way over 100. And what was happening is that this bell curve of distribution had really gotten flat. And the result from the perspective of trading and hedging is all the deltas, because as you start to move away from the center of this curve out to the tails of the curve, the deltas start to tail off. So if you move up, for example, in calls, the deltas start to go back down towards 0. And as you move down and calls are in the money, the deltas go towards 100, sort of following the curve. But it would be more steep here with the lower volatility. And as you get higher, those deltas move less and less. And what had happened during the crash, and what happens during really periods of high volatility like we had in 2008 in the fall when the markets went crazy, the deltas get very, very, they all sort of go towards 50. As volatility goes up, all deltas approach 50. And that gets reflected in a very flat bell curve. The theoretical or the intuitive reason there is simply as volatility and potential magnitude of moves become greater and greater, all strikes come into play. So suddenly, there's almost in an infinite volatility environment, all deltas would be 50. because everything is equally likely to be hit than every other strike. So that's kind of what we saw a little bit back. But you can see that this play out with a flattening bell curve as vols kind of increase slowly. Implied volatility is simply what the option market says about how volatile the underlying will be in the future. Okay, it's all about the pricing the option market is giving this. It's simply higher demand for options leads to higher implied volatility. This is simply a demand for insurance. I mean, that's at the end of the day, that's what options are. And as people get more fearful about events that are unexpected or potentially risky, or there's uncertainty in the underlying, people reach for insurance, and that's what we see. Higher implied volatility means higher standard deviation, as we saw. And the question that that I get sometimes from folks is it better to sell Vega or buy Vega? You could word this either way, but is it better to sell Vega in a high or a low implied volatility or standard deviation market? And my answer is yes, it is. And I do that sort of, the meaning behind that answer is we approach this, or my approach has always been non-directional. And of course, ideally, I would love to be able to sell if I could control everything, sell Vega in a higher volatility environment and wait for volatility to come down and capture Vega. But in reality, it's harder to predict those sorts of things because predicting volatility moves is a subtle way, really, of predicting market moves most of the time. And so we've been successful in doing short Vega trades in high volatility environments, watching Vega stay high for a while and then drift down, and even go higher and then come back. And we've seen success in low volatility environments where IV stays low. Vols tend to be very sticky, so and our stuff tends to be shorter term trading, 2 weeks to 4 weeks, 5 week stuff. So even if it's a low vol environment, it can stay low for a while, and it all comes down to these magnitude of moves that we're seeing. Really, we want the market to kind of stay within an expectation, but it can stay within those expectations in a higher and low vol environment. So anyway, at the end of the day, we're not trying to pick direction. I'm not trying to do anything. I try to trade a plan which is based on always being in the market, at least theoretically always being in the market. In that case, we just stay in, we manage risk, we may adjust size accordingly occasionally, but we're not necessarily getting out because we feel vol's too high or low. So I put this out for our guys to illustrate the idea of sort of return, potential return versus expected return, and trying to evaluate different trade scenarios. And the question that I came up with here is, what's better, a trade that can make $1 80% of the time, risking $5, or a trade that could make $10 5% of the time, risking $2? So you've got two different trade setups here. Some claim risking a lot to make a little is unwise, and I hear that once in a while, trading condors and things. But the decision is based on expected return, not potential return. And I think traders don't necessarily miss that a lot. People outside the trading miss it a lot. And you have this sort of relationship between the lottery and the savings account. The lotto, I don't remember, I think it was a year ago or maybe less than a year ago. I live in Illinois, and we're part of this like multi-state mega ball, or I don't know exactly what it is. I don't play the lottery, but there was like 15 states, and this lotto got over $1 billion, and people went crazy. I mean, they had lines going out, 2-hour waits to play the lotto. But you've got a situation like a lottery where the potential profit is gigantic, but the probability is minuscule. And then you have the flip side, the savings account, which is sort of the probability is very high because you're going to make you're going to get your money back, but the potential there, the potential return is small. So you've got sort of the lottery, which is like the out of the money long call buyer, versus the savings account, which is the conservative, maybe Condor guy, butterfly guy, out of the money calls, vertical guy or whatever. So you've got two different scenarios here. So which one do you do? So our formula is expected return equals potential profit times the probability, and then we just do the math. So the first trade, we had $1 was our cost times an 80% probability, which is 80 cents. And then the other one was $10 times the 5%, which is 50 cents. So there's our expected return. So one is going to be expected to get 80, one is expected to get 50. So then we just figure out to get that rate of return calculation, okay, and then we talk about this sometimes when we're dealing with margin on certain strategies, because now we got to say, well, how much is it going to cost us to put this stuff on? So we bring in the rate of return here. So I know on the first one, my expected return is 80 cents, but the cost to do the trade is $5. So I just do the math there, and I come up with a 16% rate of return, or expected rate of return. And the second trade, we've got that 50-cent expected return divided by the cost. So we've got 25%. So in this one, looking at it like that, we've got a higher rate of return for the second trade than the first trade. So this is just a little exercise that we do to kind of flush that math out for folks and kind of talk a little bit more about the relationship between the potential return, the probability, and expected return. Okay. Delta is probably the simplest Greek out there. Everybody understands it pretty much. If you've had any options, this is probably the first one that you learned. I teach this Greek module here at Discover Options, and we always go through the delta, the gamma, the vega, the theta, and the delta is the first one we go over, and it takes like 10 minutes. It's pretty simple. Everybody's, it's pretty generally fairly straightforward. All it represents is the change in price of an option with a given change in the underlying. It also can represent the probability of an option finishing in the money at expiration. So we do use those delta numbers to measure probability. And we use that for condors, and I'm sure, any condor traders out there probably do the same thing, especially when you're setting your short strikes and maybe your long strikes too. You look at delta. But I want to point one thing out here that some of our guys have gotten wrong at the beginning. So we've got a condor out here where the short delta on both the call and the put is set for 10. Okay, so we've got a call spread and a put spread both out of the money with the short options at a 10 delta. Okay, and so the question is, what's the probability of a condor making the maximum profit? And most people say 90% because you've got that 10 delta on the call and 10 delta on the put. The problem is it's not 90% because we've got a short call and a short put. So we've got to multiply the 90% on the call and the 90% probability in the call spread, the 90% probability in the put spread, which gives us an overall unadjusted expected probability of profit on this trade of 81%. So intuitively, you think about it, if we have a trade here that we're sitting right smack dab in the middle of the call spread and the put spread, and the market starts to sell off, the call spread is going to go into the money and can make money, but we've got a problem if this market clearly heads south. We've got to worry about the put spread and vice versa. If we rally hard, yeah, we're all good on the put spread, but now we've got to concern ourselves with the call spread, and that's why the probability of these things is a little bit lower than the short, than just looking at the short, the bigger the short strike deltas, if you will. And remember, too, that the probability of this is the expectation for unadjusted condors at expiration. So, some guys trade condor. Everybody trades condors differently, I guess. We have our approach here at Discover Options. Tends to be a little more conservative. But there are guys out there, and I've had experience with some of these guys myself, where they'll put a condor on and just leave it and just forget it. Over time, these things are gonna settle out, and they don't do any adjusting. So if you're doing adjusting, these probabilities start to get muddy because now we're doing adjustments during the trade. So okay, so that's the condor. When we do options trades, mostly these non-directional trades, butterflies, to a lesser extent condors, we often have situations where our unadjusted or just our base trade has a negative delta. Usually we deal with negative deltas. Sometimes it's positive, depending on the product. I trade mostly equities. I'm an equity guy, indexes and stock options, basically. So I'm dealing in the world where the vertical skew, where the puts tend to be at a higher implied volatility than the calls. And that kind of setup typically creates, when you trade a butterfly, a non-directional at the money equidistant butterfly, most of the time you're going to get some negative delta. Same thing with the condor. You're dealing with negative deltas unadjusted because of that more flat vertical skew in the puts than in the calls. So sometimes, so we have the situation where we're like, okay, well, I don't like this negative delta for whatever reason. I want to cover my delta. And when we talk about flat delta, and this is completely separate, but a zero delta does not mean necessarily, or a flat delta does not necessarily mean a zero delta. When I talk to my guys, okay, it's the amount of delta that I'm willing to be short or long under my given risk scenario, under the structure of the trade, looking at all the other Greeks. So sometimes we want to be short some deltas, and we call that flat delta. It doesn't mean the delta is zero. So anyway, but occasionally we get a situation, more than occasionally, where we need to buy deltas to bring that negative delta more into range of where we want to be. So there's something called dollar delta, and all it really does is it's a pretty simple way of just determining how much it's costing us per unit of delta. So if I've got short deltas and I need to buy some calls, some out of the money calls probably, or whatever, I may want to look at how much it's costing me per unit of delta. So in my example, I have the OEX D945 call. They're trading at 75 cents. And the delta is 7.5. So what I do is I just simply do a simple division, and I'll divide 75 cents divided by 7.5, and I come up with, I'm paying 10 cents per delta for that strike. And I can compare that to deltas around it to see where we are. So if the 950s are trading 40 cents for a 5 delta, I can do that math and come up with 8 cents per delta. Basically, all you're doing, it's really a way. Some guys are like number guys, and they like to see this. You're really looking at, it's really quantifying the implied volatility or the vertical skew in this thing. So when you have a lower implied volatility, especially as you take those calls and start going up strikes, due to vertical skew, you're going to have a lower dollar delta. Some guys like to quantify that and see, okay, how much am I paying per delta? You can use this to find a cost-efficient adjustment to see, because sometimes it's a little bit nebulous for some folks. If I've got a butterfly or whatever, and I need to pick up some delta, what strike should I buy? Should I whatever? And this helps to at least provide some information, but with caution. There's no free lunch. There's no free deltas. With lower dollar delta, hence lower implied volatility, tends to be lower protection. And for those of you that have traded this stuff, you probably know what I'm talking about. These markets can rally, and these really cheap deltas, dollar delta stuff, barely move sometimes. And you can really, what appears to be cheap insurance turns out to be cheap insurance, because it's not doing much when you're to protect your shorts. Because the only reason we're buying options in a lot of these short gamma theta collecting strategies, in this case, is to protect ourselves. That's it. Otherwise, I'd just be selling naked strangles all day long. But we buy these long options to simply add protection to shorts. So sometimes it appears to be a really great cost metric, but when you go ahead and do it, the performance sometimes can be a little bit disappointing in terms of the protection afforded, because the longs just don't respond very quickly to rallies. So you got to kind of balance it a little bit. Okay, the final, it's the second to final thing is the exercise assignment. Again, as some people this may be a little review for some, but this comes up again in mentoring, because we deal a lot with, we have a lot of equity option guys. And for some of the guys that haven't had a lot of experience, it gets a little bit confusing to try to understand about this. So I thought I'd put this in here. Obviously, exercise or assignment, different side of the same coin. Okay, holders of options exercise the right. Sellers are assigned, and they have the obligation. So long guys, long option holders, they have the right to exercise the short option. The seller always has the obligation. And then you have American versus European. American can be exercised anytime before expiration date. OEX. Equity options obviously are American, and that's really where we have the most exposure to this kind of issue. European options can only be exercised on expiration date, and again, you got SPX, XEO. I don't even know if XEO trades that much anymore. I don't trade it, but I know it's their European version. The OEX used to be the only product out there. In fact, the OEX was in the 80s, late 80s into the probably late 90s, was a monster pit. That was the biggest product the SIBO had. It was just jam packed with. There was like, trying to think how many guys were in there. I wasn't in there very much. I was in the SPX, but there was probably 600 or 700 market makers in there, and just I don't know how many brokers, but it was crowded. Maybe not quite that many. It was big though. Now it's nothing. Now they don't use it. But European options seem to be, SPX, XEO, RUT, NDX, options that don't allow early exercise. People like these. I think a lot of people do, especially professional hedgers, money managers, hedge fund guys that are using these products to hedge other positions. Love them because they don't have to worry about getting assigned. So they know their hedge is going to be there for, the next 60 days or whatever, and they don't worry. It doesn't matter. Whether these things go way in the money and they're not going to get assigned. So I think that's a big part of why these things have taken off the way they have. Anyway, so you've got two factors in early exercise. First of all, interest rates. Options are a levering instrument. Okay. Calls are levered, they're both levering instruments. We get leverage by employing options. As interest rates go up, calls go up. Okay, that's the levering effect. And effectively, calls lower our net borrowing cost. Okay, if Apple's trading at, $95 or something like that these days, I can either buy my 100 shares of Apple and throw down, 9,500, or I can go and buy some call for way less and control 100 shares of Apple. So the idea being that leverage is worth something. And as interest rates go up and the cost of borrowing money, even if I have my own capital and it's sitting in my bank account, and I still always, interest rates is always, the cost of borrowing is always part of the calculation. Obviously, in a higher interest rate environment, calls become more attractive because I don't have to put down as much money to control shares. For the opposite reason, puts go down as interest rates rise, and that is really due to this kind of short stock effect. Puts are like being synthetically short stock. So in a high interest rate environment, if I were to short stock, I would be able to do that and put cash in my account. And that cash in a higher interest rate environment can earn money. In some accounts, professional accounts mostly, I don't get it now. And the interest rates are nothing now anyway, but they earn short stock rebates. So in higher interest rate, in a high interest rate environment, short stock rebate can be significant. So dollars are always looking for the most capital efficient home. So if I'm long a put, okay, the way that we think about the early exercise prediction, or when somebody might exercise their put, would be if the cost of carry, or the interest rate effect, the cost of borrowing of a stock is greater than the out of the money call, then it's an exercise. Okay? If the cost of carry of a stock is greater than the out of the money call, then it's an exercise. Remember, you're only going to exercise you're in the money puts. Okay? So you look at the accompanying call, which would have, by definition, be out of the money. And this is based on synthetics. All this stuff is all this math is based on synthetics, and this is what everyone uses to determine this stuff. A long call synthetically is equal to a long put plus the stock. And I have in here, think unit replacement. So if I'm long a put, okay, I'm long one put in my inventory, and I exercise my put's going away. That put's going to disappear through the assignment, and I'm going to end up with the short stock. So I always have to think about replacing that unit. Okay, so if I get rid of my put, I need to put another one lot of something in there, and it would be the one call. So what I'm looking to do is I'm going to determine the cost of carry of that stock and compare that to the cost of the out of the money call. So if the cost of carry of the stock, because if I'm thinking synthetically, I'm thinking, okay, I'm long put, I'm long stock, even though I might not be long stock. I have to think about that. And if it's costing me 30 cents to carry the stock and the call's only trading 20, I'm going to exercise my put. And basically, I'm going to exercise my put, I'm going to buy the call, and that's going to be it. So even if you're not long stock or you're whatever, that's the math that you need to look at to make that prediction. These days, it's not really a big deal because interest rates are so cheap that the cost of carry is so small that it's hardly ever worth it to do it. But when interest rates start to tick up, this math will start to come into play a little bit more. There's no interest rate reason for early exercise of calls. So as interest rates go up, it's actually less likely you're going to exercise your call early. Remember, the long call is really a proxy for long stock. So early exercise factor number 2 is dividends. And this is one that we deal with all the time here with our guys. The value of the dividend gets removed from the stock price on the ex-dividend day. So if the company's going to pay 50-cent dividend on ex-dividend day, theoretically, 50 cents gets taken out of the value of the stock price. Obviously, there's lots of economic and financial reasons to push stock prices around, so you can't, doesn't always move exactly like that, but financially there is 50 cents pulled out because the company's going to pay the dividend. Only the shareholders get the dividend, not the call holders. So the only economic reason to exercise calls early, and that would be the day before, it occurs the day before ex-dividend. Let me rephrase that. Only reason to exercise calls early is for ex-dividend. That's the only economic reason. There's no other economic reason to exercise calls early. People exercise calls early all the time for whatever. Generally, if you get assigned and it's not an economically ex-dividend reason, you're probably going to be happy about it. It's probably going to be a profitable trade for the short call holder. So if the dividend is greater than the extrinsic value of the call, you exercise. It's simple as that. Call holders who exercise buy stock at the strike price and lose any remaining extrinsic value. So that's what they're always comparing it to. So if I own a call and I'm at I own the 50 call, I'm going to be buying the stock at 50. But if those calls have extrinsic value, I'm losing that extrinsic value. I'm giving it away, basically, because I could sell the call and collect the extrinsic value. So I'm always comparing. If that dividend is more than the extrinsic value, it's an exercise. If not, then I'm probably not going to do it. Once in a while, somebody exercises a call that shouldn't be exercised, or not very much, to be honest with you. But every once in a while, in fact, one of the guys here had an exercise on him, had some short calls assigned, and it turned out to be a very profitable trade for him because they shouldn't have been. And he didn't know, and it was a great trade for him. He was real happy once we went through the math. So we use the put as a proxy for extrinsic value. It's not a big deal, but sometimes you just look at the put. So if you got some deep in the money call, and all you have to do is look at the put, and if the put basically is going to trade at the extrinsic value. So if the put's less than the dividend, it's an exercise. So if the put's trading at 10 cents and the dividend is 20, chances are it's going to be an exercise. And you can so these are very economically predictable. But again, people exercise options for non-economic reasons, a lot. Okay, this thing called practical Greeks. Again, we spent some time with the Greeks. Most retail traders manage one position at a time. At least that's how we train our guys to this. Even if guys are trading multiple positions, and we have plenty of people that come through here, we have bunch of different trades that we teach. But we always encourage guys, look, set up an account for this trade, set up an account for, don't put them all in one account, mesh them all together, because it gets real confusing. So generally they're treating them and managing them trade by trade, even if they're having 3, 4, 5 trades at once. The decisions are based on P&L, underlying price, or time. So those are the 3 things that really drive our management criteria for trades. It's P&L. We can hit a loss, we can profit, or the underlying. Okay, there are certain triggers based on underlying, and a lot of directional guys can maybe relate to that one. Or time, we may just run out of time. We're getting too close to expiration. We tend to get out of trades within the week of, before that expiration week, most of the time. Not always, but expiration week can be a little bit dicey. The as you guys know, I mean, it can be, the risk reward profile can become very extreme expiration week. Anyway, Greeks provide risk metrics for option positions. For single position retail traders like me and like most of our guys, they are generally not needed. I mean, all the Greeks in managing positions for the most part, except for the Condor. Okay, we use Delta on the Condor. We're not in there looking at our Greeks moment by moment, managing every Greek and looking at all these things. That's how I traded when I was a market maker. That's how market makers trade, and that's how some hedge fund guys trade. When you have multiple positions pooled together, you have to look at the Greeks because you're not managing any one position. You've just got an inventory, and all you have is the Greeks. But for the rest of us now, and we don't necessarily have to trade like that. Some guys do. Some guys like to look at all that, but I don't know that it's necessary or not. So here's two ways that we use them anyway. We use it first of all to measure the risk going into a trade. Okay, most of the trades that we talk about here in our program, we set them up based on dollar allocation and P&L potential. So we have guys and we say, here's how much money we're going to allocate to the trading plan, and we chop that and we dice it up. We integrate risk overlays in it and how much we're willing to lose and the whole 9 yards, and we go through it and how much P&L, and then we chop it up and we set up a trade. The size and structure can affect the Greeks, though. So we might have different, size changes and structure changes. Obviously, is going to affect the Greeks, but it'll give us a nice picture of the risk going into a trade. It doesn't necessarily mean we're going to tweak the trade a whole lot once we see those, because we've already done the math ahead of time, so we already know what our potential loss is. If we manage it properly. But some guys look at Vega and they may not want to see that kind of Vega, maybe. We have a good idea of our gamma, so we know how this thing's going to move with respect to changes in deltas. Theta, everybody wants to watch theta, especially if you're a short, a short option trader, like we do a lot of that, because that's kind of our cash register. And so people want to see that theta number, and then obviously delta is there too. So it really does a nice picture of that. The other way that we use them is for performance analysis during the trade. Inevitably, something will happen, and somebody will say, man, I should have made this much, and I only made this much, and I can't see. And the Greeks do a nice job of explaining your P&L. Okay, because it all kind of fits together. Vega IV may have shifted, and our Vega exposure may have accounted for that. Maybe somebody didn't take that into account, or gamma. Gamma obviously affects your P&L tremendously on any kind of move. So, but it just it's just very useful for that, and that's really, that's how we kind of utilize them during the life of the trade in sort of a performance analysis tool. Okay, so basically, as an overall review here, statistics are part of trading. That's all it is. Trading is just without statistics and probability. That's it. Standard deviations are self-correcting. Okay, over time they're correct, and so I always hesitate to, be careful because, statistics over time are always right, but it's for sometimes we're not have the ability to withstand markets that get out of sync very long. We have to survive and stay in these trades and be able to ride these things out. So, but over time, standard deviations are self-correcting. Risk management, critical to profitability. We pound the table on that. Probability and potential profit determine the attractiveness of a trade. And early exercise and equity options are economically predictable. Okay, the math they can be very predictable. But again, people exercise for all kinds of reasons. And then Greeks, use them as needed. Some folks, we've got a guy here, one of the other mentors, loves the Greeks. He just pays all kinds of attention to them. But most of our guys, we just sort of use them as needed. But you got to know them. You got to understand them. Obviously, options is a language based on Greek. So anyway, those are the tools. Hopefully, those will be helpful. Whatever kind of trading you're doing, hopefully you can pull a nugget out of that. So that's what I got.
Oh, great. I really appreciate it, Steve. I don't see any questions. So if anybody has any questions, do them now or forever hold your peace, as they say. I was thinking on your conclusion slide of Mark Twain's quote, there's lies, damn lies, and statistics. And it kind of goes with options. It's a normal distribution, but obviously the markets aren't normally distributed, but, that's the best we have. So we do with those long tail events.
Yep. Yeah, well, black swan.
You just got to manage your risk.
Yeah.
So, Steve, really appreciate it. Anything you want to say about Discover Options or your mentoring, or just a little short plug for what you do?
Well, we have, if anybody is interested in any kind of option mentoring, we have this program. Go to www.discoveroption.com. We've got mentors. We got 4 or 5 of us now. Our total experience is probably close to 100 years. We've got guys who've been down there for, in this business for a long, long time, and we've seen all kinds of stuff. So we got a great program. We feel like, there's a lot of education out there, and some of it's pretty good and some of it's not so good. Our stuff's been kind of proven over time. So, we love the stuff. We love teaching it. I love teaching it. So if you're interested, if anybody's got any interest in any of that stuff, check out the website and get some information. We'd love to hear from you.
We did have a question pop up from Ted. He asked, if the out-of-the-money puts don't protect as much, should we not use at-the-money puts when the size of our trades increases in size?
Well, the puts are interesting because if you trade condors, you'll see that the put skew is very flat. And we have generally what happens when we trade condors, and I'll just use condors as an example because you've got in the money or a couple of out of money puts. When we get sell-offs, the downward move in these condors, the pain that we tend to feel is not so much delta related as it is vega related. So volatilities are going up, and we're short vega, so we're going to feel a pinch there. But I'm telling you, these puts tend to do a very good job because of that skew of providing protection. There's generally a lot of gamma in those way out of the money puts still. But if you're not getting enough protection from an out of the money put, then the only thing you can do is either buy more puts or go ahead and move where there's more gamma, because you need gamma. You need absolute gamma to provide the protection. And the way to get more gamma is to buy more put or go somewhere where the strike has more gamma, which means you go closer to the at the money. And it all comes down to money, how much you're willing to pay for the insurance. Those are always the challenges. And that's why I think it's important to kind of think about before you put, and I'm not saying Ted did this or not, but because we have this all the time, try to think this stuff ahead of time, what the adjustment procedures are with these kind of trades, because it always happens. You always need to make these kind of decisions. And there's an old saying, traders rarely get smarter during the trade.
That's a good one. Any thoughts on Brexit and what you guys are doing to maybe hedge or step aside, or how are you treating the Brexit threat coming up?
You know what? I heard over the weekend that this rally we got going today was in response to what seemed to be a favorable, that they were not leaving, that they were going to stay, which caused this rally to go. To me, somebody asked me last week. I wasn't really sure how the equity markets were going to respond because I didn't really follow it tremendously. To me, it seems a little more like a currency play than an equity play. If it's an equity play, it seems more related to trade and how in the economics concerning Britain. But it looks like today that we got a spike if it's a favorable vote. So I think when is it? A couple of days from now, 23rd, I think, is when it becomes official.
Yep, Thursday.
So I guess if it clears, then maybe today was the rally. Maybe they'll sell the fact. I don't know. We try to stick to our knitting no matter what. And even when we have these kind of these special situations where you have this kind of a situation, obviously we've got an election year coming up. We've got Fed meetings and all the time, it seems like. So we try to just stick to our risk management, stick to our knitting, and not do too much tweaking to any one particular event. So I think we kind of look at this as just another thing, and we just make sure our risk is buttoned up and we manage accordingly. So
Ted asked, do you guys do any mentoring on gamma scalping?
Yeah, we deal with gamma because I teach the Greeks. Gamma scalping, we've had guys ask about gamma scalping, and I have talked specifically about that with some guys that were interested in gamma scalping. Gamma scalping, what that really all is about, Ted probably knows, but you've got a delta position, and as markets move up and down, your deltas are going to change based on gamma. And some guys make a living scalping gamma. They'll just long gamma or short gamma. But the bottom line is, Ted, if you're interested in learning about that, call that, email us or mention, that you heard it on this webinar, and we can figure something out. Because I have had guys want specific information on how gamma scalping works. So it's possible that people do it. People think it's really easy. It's not, because you've got, it's all based on the relationship between the price of the options and the gamma you're buying. You're paying for gamma when you buy options, and you want that market to move. If the market moves and you're long that gamma, you're going to make money. It's like buying a straddle. You're playing for a move, and the question becomes, when is it? You have to determine what you're going to pay for that, and that's always a challenge.
Absolutely. All right. Well, Steve, looks like we're right at an hour. We like to end our meetings there if we can. So this looks like a good place to stop. Again, thanks for the presentation and the insights. Really appreciate you coming, and hope we have you again in the future.
No, thanks, Tom. I enjoyed it. Good trading, everybody.
Thanks, everyone. We'll talk to you later.